So now we will discuss about reinsurance. What is reinsurance? Reinsurance is basically the insurance of the insurance companies. Is the insurance of the insurance companies. Yeah. So what this reinsurance means, or why do they do reinsurance? Because the insurance companies also make losses. Yes, as we learned in terms while we were learning actuarially fair premium and all, so that means that there is misappropriation or misestimation by the insurance companies, and then they make losses. So the reinsurance companies are the ones which take care of the losses of the insurance companies. Reinsurance companies insure losses of insurance companies. Those who insure these losses, they are known as reinsurer. Those who insure the losses are known as reinsurer. Those which are insured, they are known as ceding company. Yeah, so they are sharing the risk now. So these basic insurance companies who are being insured are known as ceding company, and those who insure these ceding companies are known as or take care of the or share the risk with these ceding companies from the ceding companies are known as reinsurers. Now, when we talk about that, okay, sharing the risk or chance of making loss, the general idea or general concept what we discuss upon is net amount at risk. NAR. Net amount of risk is nothing but the difference between death benefit and reserve. Now, what is death benefit? Death benefit is the amount the insurance company has to pay during claims. It's a kind of indemnity, right? So the death benefit is the amount the insurance company has to pay towards its customers during the claims. Whereas what is reserve? The reserve is, I will take a different color. The reserve is the money or the fund created by the ceding company in purpose of paying the anticipated payouts or anticipated claims. So how they generate these reserves? Through premium, of course. So this fund, the reserve is the fund created to make the payment towards the claim, and then the claim which is arising is basically the death benefit, and therefore the difference is the death benefit minus reserve. That means the difference between my revenue. On the other way, when the reserve can be my revenue, and this can be death benefit can be my indemnity. So, and that is how we learned to estimate the losses, right? So, just taking an example, if the death benefit of an insurance company, say the death benefit is 70,000 rupees and reserve is 25,000 rupees, So the net amount at risk, it is in the negative way, right? Net amount at risk, not in the reserve. So the net amount of risk, that is the potential loss, is 45,000 rupees, right? 70,000 minus 25,000. So it's not basically, we are estimating the loss, not the profit. So it's not revenue minus cost, it's the cost minus revenue, or the death benefit minus reserve. So this is the potential loss, the health insurance company is going to make. But is it like every time they will make losses, the reinsurance companies will pay for that? No, it never happens like that, or it is not taken for that granted. So what happens, that the reinsurance companies will ask the insurance companies about a retention limit. Retention limit. So what is this retention limit? Retention limit is the maximum amount of loss the ceding company, the insurance company, yeah? Here I will say ceding company because here are two insurance companies. Ceding company is willing to incur. This is the maximum amount of loss. So they said, okay, I will, 45,000 is my net amount at risk. So my retention limit is something close to 80,000 rupees. That means I know that even if I make a loss maximum till 80,000 rupees, I have a capability that in next cycle I will, I will make it up. I'll manage it. I don't have to, ask for an insurance. In this case, a reinsurance. But what happens in case of retention limit, if it is less than, say, 20,000, the retention limit, and then the net amount at risk is 45,000, then the reinsurer or the reinsurance company has to pitch in. So and this applies for total net risk of all policies together. So it's not only one individual policy, it's a total policy, because that is the total loss the insurance company is going to lose. It's not policy specific mostly. So it's the total losses they are going to make and are making, and then based on that, what will be the retention limit. Yes, therefore, if my death benefit is around 70,000 rupees and I have a reserve of around 25,000 rupees, I have net amount at risk of 45,000 rupees. Now it depends that what will be, like depending upon the death benefit and then the reserve, you will estimate the potential loss as an insurance company, as a ceding company. Now, it's not that whenever a ceding company is making loss, the reinsurance company will insure for that loss. So the reinsurance company expects that the ceding company will, can adjust its system till a certain amount of losses can manage by themselves. So that maximum limit till which the ceding company are supposed to arrange or make up their losses, make for their losses up, then that is known as retention limit. Therefore, retention limit is the maximum amount a ceding company is willing, or maximum amount of loss a ceding company is willing to incur. That is known as retention limit, and the ceding company has to state this retention limit to its reinsurance company or the reinsurer. And this retention limit is not specifically for one particular insurance scheme. It is basically for a group of all together, considering all the insurances together, that what is the potential amount of loss or the net amount at risk, considering all the policies the insurance company has sold or the ceding company has sold to its customers. Based on that, the retention limit will be fixed. And once we fix the retention limit, that means we are moving towards the reinsurance treaty, because retention limit is a very important component of reinsurance treaty. So what is this reinsurance treaty? A reinsurance treaty is again a contract, and this contract is between the reinsurance company and then the ceding company. So a contract between the reinsurance company or the reinsurer and the ceding company. It shows that which are the losses the reinsurance company will cover, the kind of losses the reinsurance company will cover, what will be the benefits the ceding company will get, what are the retention limit the ceding company has to state, what is the time frame for which the policies are being reinsured, and based on this, and finally what premiums for this set of benefits, what premiums are to be paid and how to be paid by the ceding company to the reinsurance company. A reinsurance treaty is basically of two types. One is automatic reinsurance, and another one is facultative reinsurance. The automatic reinsurance actually is the treaty which defines the reinsurance treaty, which defines that it has to cover automatically all the insurances or the which the ceding company has forwarded or has sold to its customers, and there is no choice for the reinsurance company, where the facultative reinsurance, in case of facultative reinsurance, the reinsurance company can specifically choose that these are the based on certain criteria, that these are the insurances I am going to cover, and that when they try to selectively or select the insurances, then they will consider one policy at a time individually. So this automatic reinsurance is actually given in a So when I am giving automatic reinsurance, it is generally in two ways. One is excess and two is first dollar. In excess is when only a certain portion of the net amount at risk are being covered. It's a certain portion of net amount at risk are being over the company's retention limit. So over the company's retention limit are being insured. And in case of first dollar, it is a percentage of from the very first dollar, of under the which is coming under the net amount at risk. So what we do in this, we call it a first dollar quota share basis. So it covers a certain percentage of the net amount at risk from the very first dollar of death benefit. Yes, so these are the two types of automatic reinsurance. One is excess, where the over the retention limit a certain percentage of, say if the retention limit is 1 lakh rupees, and then the total net amount of risk is 3 lakh rupees, and then the first dollar will cover from the very first amount of that 2 lakh rupees, a certain proportion of that, whereas in case of excess, they will say that I will cover 50% of that 2 lakh rupees, so 1 lakh rupees. It's like that. So in case of facultative reinsurance, it works in a In case of facultative reinsurance, it follows 3 steps. The first step being they want the underwriting information. This reinsurance company seek this underwriting information from the ceding company. Now the underwriting information means the estimation of the probability of each of the individual or insured people's estimation of probability of falling sick for each of the for each particular policy. And then they will see whether there have been any mistake in terms of underwriting, and then that is why these insurance companies are making losses or not. So one is this underwriting, and then the next is reviewing the information and then deciding that whether that particular policy is to be reinsured or not. Because in facultative, they actually choose the individual policies, so they have this discretionary power. So they will look at each policy and will then decide. And then the third one is the company reviews all offers and then choose the first in and best offer. They choose the first in and best offer and then decide that those are the those are the insurances they are going to reinsure. And as the reinsurance companies will play very safe, because they really want to reinsure a very faulty insurance company, so or sick insurance company. So while they are going for this reinsurance, there is a concept of recapture which is floated in generally. Recapture. So what happens in this case, the ceding company also are getting some benefits. They can take back all the risk. All of the risks. In less developed market, what happens that often treaties give a statement, it is mentioned in the treaties that the company has an annual right to recapture. That means within a year they can recapture all the risks, And then the third point, what happens in the more developed markets, in the developed markets, it's very restrictive. It's more stringent, it's the recapture policy. So what happens that they are not allowed very restrictive. So what happens, first thing is that not allowed or only after a certain number of years the recapture can take place. So if you have reinsured yourself, you cannot take back the risks, you have to pay for the premiums and all. So not allowed immediately, only after a certain number of years. And then the second clause is amount limited to the increase of in the company's retention limit, so that you have to take care of the retention limit, and then if you can continuously increase your retention limit, that means you are taking care of your losses by yourselves. That you are being slowly self-sufficient and trying to help yourself out rather than banking on the insurance company. Then this retention limit increment actually convinces the reinsurer that you have this capacity to recapture. These reinsurance treaties are generally made in terms of an annual plan. They are annually renewable, and there are always an expense allowance which is generally paid under the premium, it's kind of the benefits the reinsurers often asked to compete on expense allowances, because these are the benefits that the ceding company wants to receive against their premiums, apart from that sharing the risk, you know. So these expense allowances are which make the reinsurance companies to compete with each other, because these are the basically the benefits extended to the, you know, the to the ceding company, and against the premium or the percentage of the reinsurance premiums, that I give you the benefits in terms of this many percentage, this much of percentage of the reinsurance premium. And the simplest and purest form of reinsurance is co-insurance, when, you know, two insurance companies together share the risk, you know, that is the co-insurance. That is the simplest form, but co-insurance is not basically the reinsurance, you know. It's the simplest form of co-insurance, when two insurance company, you know, take care, you know, of a risk. So the 80% of some company takes and 20% of some other company takes, and that's how it works in a reinsurance format. And the modified co-insurances, so co-insurance can be two types. One is the modified co-insurance, and in a modified co-insurance, the ceding company pays interest, you know, for the protection. So, and it has, you know, there is a clear distinction about the ceding company and the reinsurance company. And the other one, the B, can be co-insurance with funds withheld. That means that the funds of the ceding company will be withheld, funds with co-insurance, where you know, with funds withheld. So where the funds of the ceding company will be withheld with the co-insurer, so that they have a kind of the reinsurance company has a control over the ceding company, and the ceding company are accountable that they have to keep the retention, they have to keep their business in a sensible way, so that they are always within the retention limit, unnecessarily not extending this. So thank you.